Have you ever noticed how the rich seem to get richer no matter what happens? Even when the economy takes a nosedive, they still find a way to come out ahead. And yes, you heard that right. Last year alone, billionaires added almost $3 trillion to their net worth, while everyone else was dealing with inflation, rising interest rates, and economic uncertainty. So here's the million-dollar question. What's their secret? Why are they winning while so many of us are struggling? Well, the good news is that it's not luck. It's strategy. And today I'm going to spill the beans on exactly where the smart money is heading in 2025 and how you can use the same moves to grow your wealth. That's right. We're diving into the world of high finance to uncover the secrets of the wealthy. No fancy degrees required. So grab a seat and let's unpack the strategies that are making the rich even richer. Now let's talk about what's going on in 2025. Interest rates are playing musical chairs, inflation seems like a stubborn house guest who won't leave, and the good old savings account you trusted is now losing its appeal. In simple terms, if you've got your cash sitting in a savings account, it's actually losing value slowly. Think of it like putting your money in a time capsule that's slowly eroding away. The numbers might look small, like 0.5% here, 0.75% there, but over time it adds up. So where are the big players, the hedge funds, the pension funds, even those billionaire families putting their money? Spoiler alert, they're not taking any chances with risky tech stocks or chasing the latest crypto craze. Instead, they're steering clear of volatility and investing in sectors that have stood the test of time: healthcare, energy, and consumer staples. Let's break these down real quick. Healthcare includes companies involved in pharmaceuticals, medical equipment, and health services. Energy encompasses oil and gas exploration, utilities, and renewable sources. Consumer staples are everyday essentials like groceries and personal care products. Basically, these are the sectors that keep humming along no matter what the economy throws at them. But why are these sectors so appealing to the smart money crowd? Well, first off, stability. People's needs for healthcare, energy, and daily essentials don't change much, even when the economy is feeling a bit under the weather. Secondly, these sectors often have pricing power. When input costs rise, these companies can pass those costs on to consumers without losing their competitive edge. Lastly, they tend to pay decent dividends, which is a win-win for investors. Okay, let's take a closer look at some blue-chip stocks. These are companies that have been around for decades and have proven themselves over time. Think Johnson & Johnson, Coca-Cola, or Microsoft. Now, Johnson & Johnson, a name synonymous with healthcare, has been around since 1886. This company doesn't just manufacture medicines, they're a household name with a portfolio of trusted brands. Similarly, Coca-Cola, the beverage giant, has quenched thirsts worldwide for over a century. And then there's Microsoft, a name synonymous with innovation in the tech world. These companies may not make flashy headlines, but they're the backbone of the market, consistently delivering results year after year. Why do these blue chips appeal to the smart money crowd? Well, imagine these companies as the oak trees in an investor's forest. Just as oak trees stand tall and strong, these companies have weathered countless economic storms and emerged stronger. Their roots run deep in the business world, anchoring them against market turbulence. Unlike fast-growing startups that might seem like the exciting saplings in the forest, blue chips offer a different kind of allure. They provide stability, reliability, and a steady growth trajectory. For investors, that means a smoother, more predictable journey toward their financial goals. But here's the kicker. Blue chip stocks are not just about resilience. They're also about dividends. Many of these companies share their profits with shareholders through dividends, providing a stream of passive income. It's like having a little financial safety net that keeps growing over time. Now let's talk about something that might sound a little intimidating, but is actually super straightforward. Exchange-traded funds, or ETFs for short. Think of ETFs as baskets that hold a bunch of different stocks or bonds. Want exposure to the S&P 500, the general stock market? There are ETFs for that. Looking to dip your toes into the tech world, or maybe interested in renewable energy? Guess what? There are ETFs for that too. With just one investment, you can spread your risk across multiple companies. It's like putting together your own investment portfolio, but in one neat package. The best part? ETFs are generally pretty cheap to own, especially compared to the fees charged by some mutual funds. This means more of your money stays working for you instead of lining someone else's pockets. Here's a fun fact. Over the past 2 decades, most professional fund managers have actually failed to beat these basic ETFs. That's right. Many of these so-called experts haven't even kept up with the market. So why pay hefty fees for someone who might not outperform the market when you could invest in an ETF and save some cash? And here's another bonus. Many ETFs offer international exposure, giving you a chance to invest in companies beyond the borders of your home country. In 2025, countries like India and Vietnam are expected to grow faster than the U.S. economy. So including a bit of international flavor in your portfolio can be a smart move. You see, ETFs are like that friend who brings a whole spread of appetizers to a party, ensuring there's something for everyone. Your money is diversified, less risky, and you're all set for long-term growth. Here's the thing. Being patient is key in investing. It's like waiting for the perfect ingredients to come together to make a delicious meal. Sure, you could rush it, but where's the fun in that? The real magic happens when you wait for the right moment and let things unfold naturally. Imagine you're baking a cake. You wouldn't throw the batter in the oven before it's fully mixed, would you? That's exactly how investing works. It's not about chasing the latest trends or jumping in and out of investments based on every news headline. It's about understanding the fundamentals, waiting for the right opportunities, and sticking to a plan. Patience is like that secret ingredient in a recipe that transforms ordinary ingredients into an extraordinary dish. It's the X factor that can turn a good investment strategy into a truly winning one. Look at Warren Buffett, the legendary investor. He's not known for making snap decisions. He waits patiently for the perfect investment opportunity, often holding off until he sees a company that's priced lower than its true value and has a solid foundation for growth. Patience allows him to avoid the pitfalls of investing in hyped-up companies that might look good on paper, but do not have the staying power to back it up. But let's say you're not Warren Buffett and you don't have millions to invest. How does patience help you? Well, let's say you're investing in index funds, which is like putting your money in a basket of stocks that tracks a particular market. Imagine you're building your investment portfolio. Instead of panicking when the market dips and you feel like you're losing money, patience lets you stay focused on the long term. You realize that dips in the market are normal and a chance to buy in at a lower price. Patience is your anchor during storms in the market. It keeps you from making rash decisions that you might regret later. Think of investing as a marathon, not a sprint. Chasing quick wins and trying to time the market perfectly is like sprinting. But that's not the way to go. You're much more likely to succeed if you pace yourself, stay focused on the long term, and keep moving forward steadily. And guess what? This approach isn't just about keeping calm and carrying on. It's about making smarter decisions. When you're patient, you have time to research, to analyze, and to understand the investments you're considering. You're not just throwing your money into something because everyone else is doing it or because you fear you're missing out. So how do you cultivate patience when it comes to investing? Well, start by educating yourself. Understand the basics of investing and don't fall for every shiny new investment scheme that comes along. Next, have a plan. Know your financial goals and how much risk you're comfortable with. A well-thought-out plan helps you stay focused on your objectives and resist the urge to make impulsive decisions. Finally, keep learning. Stay updated on market trends and be prepared to adapt your strategy as needed. Remember, in investing, as in life, patience is a virtue. It might not be the most exciting quality, but it's certainly one of the most powerful. So there you have it, folks. The blueprint for building wealth is right here, right now. It's not about get-rich-quick schemes or chasing the hottest trends in town. It's about making smart, informed decisions, diversifying your portfolio, and above all, exercising patience. So what's next? Well, it's time to put this knowledge to work. Take that first step, open a brokerage account, whether it's Fidelity, Schwab, or M1 Finance. The choice is yours. Start small. Even $50 or $100 a month can make a significant difference over time. Consistency is key. Invest regularly and let compounding interest work its magic. Remember, you don't need to be a Wall Street guru to build wealth. You just need a solid plan, a bit of patience, and a dash of consistency. So, go ahead, embrace the mindset of a wealth builder and watch your financial future flourish. And hey, don't forget to subscribe for more valuable content. And if you've enjoyed this video, give it a thumbs up and drop a comment below telling me what you found most helpful. Thanks for joining me on this journey towards financial success. Until next time, happy investing.